Now we have a guest. We have Kunj Bansal, who is partner and CIO at Sarthi Group, joining us. Good afternoon, Kunj. Look at what markets are doing. There doesn't seem to be a pause, no doubt. It did recover quite a lot from its lowest point for the day, but still, Nifty triple-digit cut. What do you make of such a move?
It's difficult to make anything out of this move. Of course, having said that, if we go and analyze what we find is that, or rather to analyze that, let's just put ourselves a month ago, wherein we had this dichotomy, where we had this dilemma that macroeconomic numbers were not supporting. GDP growth rate for Q1 had come to a low of 5.8%. Exports had not been growing, and micro economy wise corporate earnings were not growing. And mind you, corporate earnings haven't not grown only in this quarter, they have not been growing for last 3 quarters now. And we had markets at the life high, mainly in terms of large cap indices, Sensex and Nifty. And then we had these discussions that why market is high when the macroeconomic numbers and microeconomic numbers are not supporting. So here we are, market has finally taken cognizance of the bad macro and bad micro, and as a result has corrected. So I think it's a situation which logically is more rectified than it was a month ago. The reason, the trigger in between could have been any. Did the budget become a trigger? Possibly yes. Did the taxation increase in the budget become a trigger? Possibly yes. But as I said, the situation is more logically explainable now than it was a month ago. Macro and micro support hasn't been there. Market was continuing to go high, or rather remaining high, has at least now corrected 10%. So I think from a longer term investment point of view, that's a healthy situation. Of course, in the short term, there have been sharp fall, sharp losses, probably can continue for some more time.
Kunj, where do you see pockets of safety in this kind of market? Are the valuations now attractive, or they're still expensive, do you think?
So these are two different questions. I don't think I can mix the answer to these two questions in one, so I'll try to answer them separately. One, in terms of pockets of safety, that's why we in the market always have these aggressive and defensive high beta and low beta sectors. And typically the low beta sectors, the defensive sectors, are the information technology and FMCG, the consumer goods. And if we notice also in last 1 month or so, or even if we take 2 months, 10% large cap indices fall, these are the two sectors which have clearly outperformed. The share prices either haven't fallen as much, or in fact in some cases, like in some of the FMCG companies, have actually gone up. This hasn't been as much applicable to mid cap IT, but has certainly been applicable to large cap IT. So that's as far as the pocket of safety or the defensive availability is concerned. Valuation, I think, has become corrected or come down on a relative basis. On an absolute basis, they have certainly not come down even now, especially in the good quality, high growth companies, at a level at which I could call them value investing, or at an absolute valuation level, which is where I would be more comfortable investing. But yes, in relative terms, a lot of stocks have corrected anywhere from 15 odd percent to 35 odd percent. And mind you, these stocks also include those top 7, 8, 9, 10 stocks which were continuing to go one way up because of the continued institutional buying over the last 1 or 2 years.
All right.